Wilson. He is the chief U.S. equity strategist for Morgan Stanley. Welcome back.
Hey, Scott, how you doing?
Good, thanks. That's an issue to think about, right? Rising rates, and you think they're going to continue to go up.
Yeah, I mean, look, I think there's always issues. I mean, our job as strategists is to try and shed light on things that people may not be paying attention to. First of all, the equity market is traded already as if rates are going up, meaning all of these, cyclical stocks have moved in advance of what we think will be a higher rate move. Now, rates have moved up to support that idea, but we think they could go up quite a bit more over the course of the next, several months. And we have a lot of things right in front of us that are happening, whether it's the Biden proposal for more stimulus, Janet Yellen's testimony. She's very supportive of that kind of a view. That drives more inflation. It drives rates higher. And, yeah, there are a lot of stocks in the last, call it 10 years that have benefited from falling nominal and real rates. And if that goes in reverse, it doesn't mean they have to get crushed or go down, 40%. It just means that they're going to lag in this sort of more cyclical recovery that we're still pricing.
I mean, Yellen gives you exactly what you're talking about today, right, with the go big. And that's what
right.
The market has been moving on, and maybe even more so once it became clear that Democrats were going to have control of the Senate.
That's exactly right. I mean, the political environment has changed dramatically just in 3 months. I mean, and it's been kind of a drumbeat, and, that's not going to reverse. I mean, that's where we're going. And this has been part of our thesis all year, as Scott, since March, is that we said, look, the policy response this time around is going to be gargantuan because it's a health crisis. And, that's only going to continue further with the political change in Washington. And that's all good for growth, and it's good for inflation, but it also means rates could move up in a nonlinear fashion.
I mean, you have to assume the Fed would get involved even more at that point, right?
Well, why? I mean, let's just talk about that for a second. The Fed's goals are to get unemployment back to where it was. That's their primary goal. Let's get a full recovery. And if rates start going up because, in fact, the economy is improving faster than maybe anybody expected 3 or 4 months ago, and don't forget, the Fed laid their plans out 3 or 4 months ago when we didn't have vaccines and we didn't know the outcome of the election, and there was a lot of grandstanding in Congress. Well, that's not going to be the case anymore. So they have to adjust their thought process, right? They do have to have some, sort of two-way risk in the market at some point. And letting back-end rates go up because growth is better, how does that kill the economy? I don't think it will.